I've spent the last 6 years taking over 50,000 trades, and I can tell you with absolute certainty that almost everything you've been told about trading psychology is wrong. You've been told to trade like a robot, eliminate emotions, and follow your plan. But here's the problem. You're not a robot, and pretending to be one is exactly why you're still losing money. Every trader who watches this video thinks their issue is discipline. They think if they just had more willpower, they'd be profitable. That's not your problem. Your problem is that you're fighting a war against greed and fear without even knowing. These are the only two enemies you have. In the next 30 minutes, I'm going to show you exactly how these two emotions disguise themselves as overtrading, revenge trading, FOMO, and every other issue bleeding your account dry. I'll give you the specific fixes that took me from breaking even to making consistent 5-figure months. By the end, you'll understand why your desire to make money is the exact thing preventing you from making money. And more importantly, what to do about it. This isn't motivational content. This is the unfiltered truth about what actually separates profitable traders from everyone else. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let me start by addressing something that's going to sound completely backward to you. The worst advice circulating in trading communities right now is this idea that you need to trade like a robot. I see it everywhere. Instagram posts with quotes like, "Remove emotions from trading," or "Be mechanical in your execution." It sounds professional. It sounds disciplined. Yeah, and it's completely impossible to implement. You are not a machine. You have a nervous system that responds to stress, dopamine receptors that fire when you see green candles, and an amygdala that activates when you're down $2,000 on a position. Telling yourself to ignore these biological responses is like telling yourself to stop your heart from beating when you run up a flight of stairs. It's not going to happen. What actually separates professional traders from amateurs isn't the absence of emotions. It's the management of them. When I enter a trade and I'm risking $500, I feel something. When that trade moves against me and I'm down $300, I feel something different. The difference between me now and me 3 years ago isn't that those feelings disappeared. It's that I built a recognition system. I can identify when greed is telling me to add to a position that's already at my risk limit. I can spot when fear is making me hesitate on a perfect A-plus setup. The emotions are there. They're just not in the driver's seat anymore. Most traders fail because they're trying to fight a war they can't win instead of learning how to negotiate a peace treaty with their own psychology. This is why your trading plan can't just be technical criteria. It has to include emotional checkpoints. Before I enter any position, I run through a mental checklist that has nothing to do with support and resistance. Am I entering this trade because the setup matches my criteria? Or am I entering because I just took a loss and I want to make it back? Am I sizing this position based on my risk rules? Or am I sizing it based on how much money I think I can make? These questions take 3 seconds to answer, and they've saved me tens of thousands of dollars in losses. You're not eliminating emotions. You're creating a filtering system that catches them before they execute bad trades. Now let's talk about the first way these emotions actually show up in your trading, because this is where most of you are bleeding money without even realizing it. Every single issue you have in trading boils down to 2 emotions: greed and fear. Not 5 emotions, not 10, just 2. And greed shows up first, disguised as something that sounds productive. It shows up as ambition. It shows up as drive. It shows up as you staring at your charts at 9:45 in the morning thinking, I need to find a trade. That last part, that need to find a trade, that's not ambition. That's greed wearing a mask. Overtrading is the most common symptom of greed. And I need you to understand what overtrading actually means, because most traders define it wrong. Overtrading isn't taking 10 trades in a day. It's not about quantity, it's about quality. Overtrading is when you take setups that don't meet your criteria because you want to be in the market. You're forcing trades that aren't there. You see a stock making a move, and you convince yourself it fits your plan when it doesn't. Why? Because you have a deep, almost desperate desire to make money today, right now, in this moment. That desire is what's stopping you from making money. Here's how this actually plays out. You have a trading plan that says you only take A- setups or higher. You're watching the market and you see something that's maybe a B+, maybe a B. The setup has some of the criteria you look for, but not all of it. Maybe the volume isn't quite there. Maybe the risk-reward is slightly off. Maybe the overall market context isn't ideal, but you've been sitting there for 40 minutes and you haven't taken a trade yet, and you're getting anxious. So you take it anyway. You convince yourself it's good enough. And maybe it works. Maybe you make money on that trade. But more often than not, it doesn't work. And now you're down money on a setup you knew wasn't ideal from the start. The fix for this isn't willpower. The fix is a written document that contains the exact criteria for what makes an A+ setup in your strategy. Not vague concepts. Specific, measurable criteria. For me, an A+ setup in my day trading strategy requires 5 things to be present simultaneously. The stock needs to be in a clear trend on multiple time frames. It needs to have above average volume. It needs to be pulling back to a specific level that I've identified as high probability. The overall market needs to be supporting that directional bias. And the risk reward needs to be at least 1 to 2, preferably 1 to 3 or better. If all 5 of those criteria aren't present, it's not an A+ setup. It might be a B+ setup, and I might take it occasionally if I'm feeling aggressive and the market conditions are exceptional. But most of the time, if those 5 things aren't there, I don't take the trade. Period. This is where most of you fail. You don't have this written down. You don't have alarm bells in your brain that go off when you see a real setup versus a mediocre one. You're making decisions based on feelings, based on whether you've made money today yet, based on whether you're bored. Trading out of boredom is greed. Trading because you haven't hit your profit target for the day yet is greed. Trading because you want to feel productive is greed. All of it comes back to this underlying desire to make money, overriding your logical assessment of whether a quality setup is actually present. And here's what makes this so dangerous. Greed doesn't just make you take bad trades, it makes you take catastrophically bad trades. This brings me to the second manifestation of greed, which is over-leveraging and over-risking. I've seen traders, people I know personally, make consistent profits for 3 months, and 6 months, even a full year, and then give it all back in a single trade, one trade. How does that happen? They break their risk rules because they see what they think is the trade of the century, and they want to maximize their gains. They risk 5% of their account instead of their normal 1%, or they risk 10%, or they go all in because they're so sure this is going to work. Let me be very clear about something. You will never ever be sure about any trade. I don't care how perfect the setup looks. I don't care if every technical indicator is aligned, if the fundamentals support it, if the entire trading community is talking about it. You cannot be certain. The market does not owe you anything. And the moment you start thinking you found a guaranteed winner is the exact moment you're about to learn an expensive lesson about position sizing. I have a hard rule in my trading. I cannot lose more than $500 to $600 on any single trade. That's it. It doesn't matter how good the setup looks. It doesn't matter if I think it's going to be a 10-bagger. My maximum loss per trade is $600. Why? Because I've done the math on my account size and my risk tolerance, and I know that I can take 10 losing trades in a row at $600 each and still be in the game psychologically and financially. That's my survival ceiling. Do I want to take 10 losers in a row? Absolutely not. But could I survive it? Yes. And that's the difference between still having a trading career next month versus blowing up your account this week. You need this rule for yourself. You need to know the specific dollar amount that represents your maximum loss per trade. And you need to never, under any circumstances, break that rule. Not for the perfect setup, not for the trade you've been waiting for all week, not because you're down for the month and you need to make it back. The rule exists specifically for those moments when you want to break it. That's when it matters most. But it's not just per trade risk. You need a daily stop-out rule. For me, if I lose more than $1,500 in a single day, I'm done. I close my platform. I walk away from my desk. I don't care if it's 10 in the morning, and I've only taken 2 trades. I don't care if the market is setting up perfectly for my strategy. I'm done for the day. Why? Because once I'm down $1,500, I'm no longer trading with a clear head. I'm trading emotionally. I'm trading to make back what I lost. And that's when the real damage happens. This is where revenge trading enters the picture. And revenge trading might be the most expensive psychological trap in all of trading. Here's how it works. You take a trade on a stock, let's say it's ticker XYZ. You think it's going higher. You enter with your normal position size and risk. The trade immediately moves against you and stops you out for a loss. Now you're down $400 and you're frustrated because you really thought that setup was going to work. So what do? You wait for another setup on that same stock. It starts to show some bullish movement again. You jump back in, maybe with a slightly larger position this time, because you want to make back what you just lost. And it stops you out again. Now you're down $800 on the same ticker. And you're angry. You're personally offended by this stock. It feels like it's attacking you specifically. So you do it again. You take a third trade on the same stock, and this time, you're not even looking at your criteria anymore. You're not checking if it's an A-plus setup. You're trading because you lost money on this stock and you want to beat it. You want to prove you were right. This isn't trading. This is ego warfare. And the market doesn't care about your ego. The market will take your money every single time you trade with emotion instead of criteria. The fix for revenge trading is simple but requires discipline. If I lose more than 2 times on the same stock in one day, I remove it from my watch list. It's gone. I don't care if it sets up perfectly an hour later. I don't care if it does exactly what I thought it was going to do. I'm out. I'm not trading that ticker again today. If you only trade 1 or 2 instruments like NQ or ES futures, then your rule needs to be that after 2 or 3 losing trades, you're done for the day entirely. You don't get a 4th chance to prove you were right. You step away and come back tomorrow with a clear head. Everything I've just described, overtrading, overleveraging, revenge trading, all of it stems from the same root. Your desire to make money is so strong that it's overriding your logical decision-making process. You want results so badly that you skip the part where you actually do the work correctly. And this brings me to one of the most destructive forms of greed, which is impatience. Most people who get into trading aren't actually interested in becoming skilled traders. They're interested in making money. And I know that sounds like the same thing, but it's not. Being interested in making money means you're focused on the outcome. You want to turn your $5,000 account into $50,000 as fast as possible. You want to quit your job in 6 months. You want to be posting screenshots of your wins on social media. That's outcome-focused thinking, and it will destroy you. Being interested in becoming a skilled trader means you're focused on the process. You want to understand what makes a high-quality setup. You want to learn proper risk management. You want to develop the psychological resilience to handle losing streaks without breaking your rules. That's process-focused thinking, and it's the only approach that leads to consistent profitability. Here's the reality that nobody wants to hear. You're probably going to need anywhere from 6 months to 2 years to become consistently profitable. Maybe longer. I don't know you. I don't know your background. I don't know how much time you can dedicate to this. But the timeline is measured in months and years, not days and weeks. And most of you aren't willing to accept that. You think you're different? You think you're going to figure it out faster than everyone else? You're going to cut corners, skip the boring parts, jump straight to the strategies that make money. That impatience is greed. You're so focused on getting to the destination that you refuse to walk the path. And here's the cruel irony. The more you focus on making money, the further away it gets. The more you focus on becoming genuinely skilled at reading price action, managing risk, and controlling your psychology, the closer the money comes to you. I have never met a truly skilled trader who doesn't make money. But I've met thousands of people who want to make money with trading and can't do it because they never became skilled. Stop thinking about the money. I know that's what brought you to trading in the first place, but it needs to stop being your primary focus. Your primary focus needs to be on building competence. The money is a byproduct of competence, not the other way around. And you wouldn't expect to become a surgeon by watching YouTube videos for 2 weeks and then cutting people open. You wouldn't expect to become a lawyer by reading a few books and then representing clients in court. But somehow you think you can become a profitable trader by watching some courses and jumping into the market with real money after a month of practice. The math doesn't work. The timeline doesn't work. You need patience. And if you can't find patience, you need to ask yourself if you're actually interested in trading or just interested in making quick money. If you're finding value in this breakdown of how greed is sabotaging your trading, do me a quick favor and subscribe to Trader's Bible. Hit the notification bell so you don't miss the next video where I'm going to break down exactly how to build a trading plan that accounts for all of this psychology. And drop a like. If this is making sense so far, it helps the algorithm show this to other traders who need to hear it. Now let's talk about the last major way greed shows up, and this one is subtle because it feels like the opposite of greed when it's happening. It's holding winning trades too long. You enter a position and it immediately starts working in your favor. You're up $500, then $800, then $1,000. You're feeling amazing. This is exactly why you got into trading. And then something happens in your brain. You start thinking about how much more you could make if you just held a little longer. You're up $1,000. But if this thing really runs, you could make $3,000, maybe $5,000. This could be the home run trade, so you ignore your exit plan. You had a plan to take partial profits at $1,000 and let the rest run with a trailing stop. But you don't take the partials because you don't want to leave money on the table. You want the full move, and then the trade reverses. Suddenly you're up $800, then $600, then $400. You start telling yourself it's just a pullback. It's going to bounce and continue higher. But it doesn't. It keeps dropping. And now you're up $200 on a trade that was up $1,000 10 minutes ago. And you're paralyzed with indecision. Do you take the $200 and accept that you gave back $800 in profits? Or do you hold and hope it comes back? Eventually, it stops you out at break even. Or worse, it turns into a losing trade. And you sit there staring at your screen thinking about how you could have made $1,000, but instead you made nothing or lost money. This is greed. Your desire to maximize your profits overrode your logical exit plan. You got greedy, plain and simple. The solution is non-negotiable. You need an exit plan before you enter the trade, and you need to follow it religiously. My exit plan involves taking partials. If I'm risking $500 on a trade and I'm up $1,000, which is 2R or 2 times my risk, I'm taking at least half of the position off. I'm locking in $500 of profit. The trade can do whatever it wants after that, but I've already won. I can let the other half run with a trailing stop and try to catch more upside, but I've secured gains. I'm no longer at risk of turning a winner into a loser. Most traders refuse to do this because taking partials feels like you're admitting you don't think the trade is going to continue. It feels like you lack conviction. But conviction doesn't pay your bills. Profits pay your bills. And partial profits are better than no profits, which is what you get when you hold too long and watch your winners turn into losers. If you don't have a clear exit strategy that includes taking partials, you're going to keep making this mistake over and over again until it breaks you psychologically. So that's greed. Those are the 5 main ways it shows up. Overtrading low-quality setups, over-leveraging and over-risking, revenge trading, our impatience with the learning process, and holding winners too long. Every single one of these is costing you money right now, today. And if you're honest with yourself, you're dealing with at least 3 of them, probably all 5. But greed is only half the equation. The other emotion destroying your trading is fear. And fear is actually more insidious than greed because it often masquerades as prudence or caution. Fear keeps you out of winning trades. Fear makes you exit too early. Fear convinces you that you're not good enough to do this. Let's break down exactly how this works. The first manifestation of fear is the fear of being wrong, and this is rooted in ego. A lot of traders, especially beginners, care more about being right than making money. They can't separate their self-worth from their trading performance. When they enter a trade and it immediately moves against them, it's not just a losing trade, it's a personal attack on their intelligence. They were so sure it was going to go up, they analyzed the chart, they had conviction, and now the market is proving them wrong. And that hurts. So what happens? They hold losing trades too long because admitting the loss means admitting they were wrong. They move their stop-loss further away to give the trade more room to work, when really they're just avoiding the emotional pain of being incorrect. Or they freeze up entirely and can't make decisions because they're paralyzed by the possibility of being wrong again. Here's what you need to understand. Trading is not about being right or wrong, it's about making money. Those are two completely different things. You can be right about the direction and still lose money if your entry or exit was bad. You can be wrong about the direction and still make money if you cut your loss quickly and the next trade works. Being right is an ego game. Making money is a probability game. And if your ego is driving your trading decisions, you're going to blow up your account eventually. The fix is to completely reframe how you think about losses. A loss is not a failure. A loss is tuition. It's the cost of doing business. If you risk $500 on a trade and it stops you out, you didn't fail, you protected your capital. You followed your risk management rules. You executed your plan. That's a win from a process perspective, even though it's a loss from a P&L perspective. You need to start measuring success by whether you followed your rules and not by whether the trade made money. If you followed your rules and lost, that's a successful trade. If you broke your rules and made money, that's a failed trade because you got lucky and luck runs out. The second fear is the fear of losing money, and this shows up as hesitation. You see a perfect A+ setup. All your criteria are there. Everything is aligned. You should be clicking the buy button, but you don't. You hesitate. You second-guess yourself. You think, what if it doesn't work? And then it moves without you and does exactly what you thought it was going to do. And now you're sitting there angry at yourself for not taking it. This hesitation is fear of losing the money you're about to risk. And if you're experiencing this, it means one thing with absolute certainty. You're risking too much. The amount you've decided to risk on each trade is psychologically too large for your current comfort level. The solution is simple. Lower your risk. Risk less money per trade until you reach a point where you're comfortable pulling the trigger. There's a sweet spot you need to find. You need to risk enough that you care about the outcome, but not so much that you're afraid to execute. If you risk $10 per trade, you don't care. You'll click the button without hesitation, but you also won't care about following your rules because the stakes are so low. If you risk $5,000 per trade, you'll care a lot, but you'll be too afraid to execute unless you're 100% certain, which means you'll miss most of your setups. You need to find the amount where you're engaged enough to take it seriously, but comfortable enough to execute without fear. For most beginner traders, this is somewhere between $50 and $300 per trade, depending on account size. For me, at my current account level, it's around $500. Find your number and stick to it. The third fear is FOMO, the fear of missing out. You see a stock making a huge move and you weren't in it. You either missed the entry or you passed on it earlier, or you didn't even have it on your watch list. And now it's up 20% and you're watching it run and you feel like you're missing the trade of the century. So you jump in late, way above your ideal entry point, with no real plan other than hoping it continues. And it doesn't. It reverses right after you enter, and you lose money on a trade you should have never taken. FOMO is fear disguised as greed You're not entering because it's a good setup, you're entering because you're afraid of missing profits. And here's the hard truth you need to accept. You are going to miss trades. Lots of them. Thousands of them. There will be trades that run 50%, 100%, 500%, and you won't be in them. That's okay. That's normal. That's part of trading. There are always more opportunities. The market is open every single day, presenting new setups. You don't need to catch every move. You just need to catch the ones that fit your plan. I watched a trade last month that would have made me $30,000 if I had played it perfectly. I didn't take it because I missed the entry window. And instead of FOMOing in late and probably losing money, I let it go. It hurt. I thought about it for the rest of the day. But I did the right thing, because jumping in late would have been breaking my rules, and breaking my rules always cost me more in the long run than missing one good trade. You need to develop this same mentality. There will always be another trade. Always. The fourth fear is the fear of not being good enough, and this manifests as constantly switching strategies. You try momentum trading for 2 weeks and you don't become profitable, so you switch to mean reversion. That doesn't work after a month, so you switch to swing trading, then options, then futures, then crypto. You're constantly jumping from strategy to strategy, from mentor to mentor, from Discord group to Discord group, looking for the magic system that's finally going to work for you. But the problem isn't the strategy. The problem is that you don't stick with anything long enough to master it. You're not giving yourself time to develop the pattern recognition and execution skills necessary to trade any strategy profitably. You lack confidence in your ability to learn and improve, so you keep looking for shortcuts. You keep thinking the next thing is going to be easier or better. It's not. Every strategy requires the same fundamental skills: risk management, emotional control, and consistent execution. If you can't do those things, it doesn't matter what strategy you're trading. The solution to this is honestly to have a mentor or coach who can guide you through one specific approach and hold you accountable to sticking with it. Someone who's already profitable and can show you that the strategy works when executed correctly. This removes the doubt. You're not wondering if the strategy is viable anymore. You're just focused on improving your execution of it. And I'm not saying this because I want to sell you something. I'm saying it because it's true. Every successful trader I know either had a mentor or spent years figuring it out the hard way through trial and error. The mentor path is faster and less expensive in terms of both time and lost capital. Now let me give you some practical frameworks for dealing with all of this psychology in real time, because knowing about these issues intellectually doesn't help if you can't implement solutions when you're actually sitting in front of your charts with money on the line. First, start every trading day in the green. This is non-negotiable for me now. When the market opens, my first priority is to make sure my first trade is a winner, even if it's small, even if I have to lower my risk to $50 instead of my normal $500. I want to see green in my P&L column before I do anything else. Why? Because starting the day positive completely changes my psychology for the rest of the session. I'm not trying to dig out of a hole. I'm not feeling pressure to make money. I'm relaxed and confident in trading from a position of strength rather than desperation. Try this for 1 week and watch how it transforms your trading. Second, the break-even milestone. Most traders are trying to jump directly from losing money to making life-changing profits. They want to go from beginner to rich. But there's a critical phase in between that you're skipping. The break-even trader phase. This is where you learn to stop losing money consistently. You're not making big profits yet, but you're also not bleeding your account anymore. You're breaking even or making small, consistent gains. This phase is essential because it's where you develop the risk management and psychological skills that will eventually allow you to scale up and become highly profitable. If you're currently a losing trader, your goal shouldn't be to make $10,000 a month. Your goal should be to break even for 3 months straight. That's it. Focus entirely on protecting your downside, on not losing money, on following your rules even when it means missing trades or taking small losses. Once you can break even consistently, profitability becomes almost automatic because you've learned the hardest part, which is not giving back your gains. Third, stepping away. When you feel yourself getting emotional, when you catch yourself thinking about revenge trading or FOMOing into something or breaking your risk rules, you need to physically step away from your desk. Go for a walk, get a drink of water, do 10 push-ups. I don't care what you do, just create physical distance between yourself and your trading platform. This breaks the emotional spiral. It gives your logical brain a chance to catch up with your emotional brain. I've saved myself thousands of dollars by walking away for 10 minutes, instead of taking the emotionally driven trade I was about to execute. And finally, the most important thing, discipline is not a personality trait. It's a system. You can't rely on willpower or motivation to follow your rules. You need to build external systems that make it harder to break your rules than to follow them. This means having written rules for maximum loss per trade and per day. It means having a checklist you physically go through before entering any position. It means having an accountability partner or mentor who reviews your trades. It means setting up your platform so you literally cannot risk more than your maximum without multiple confirmations. Every issue I've talked about in this video, all the greed-driven mistakes and all the fear-driven mistakes, they all come down to a failure of discipline in the moment. And you fix that not by trying to become a more disciplined person, but by building systems that enforce discipline for you even when you don't feel like being disciplined. That's the truth about trading psychology that nobody wants to tell you. It's not about motivation or mindset or positive thinking, yet it's about understanding the 2 core emotions that drive all your decisions, recognizing when they're influencing you, and having concrete systems in place to prevent them from destroying your trading account. Everything else is just noise. If this video was of value to you and would love to see more of this, do well to subscribe, click the like button. See you in the next one.